Happy Tuesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Tuesday, November 21st, 2023. As always, we'll start with our executive summary from today's leadoff morning note. If you want the analysis supporting these conclusions, as well as what to do about them in your portfolio, obviously need to be a client of 42 Macro. So we'll start with number one. The global liquidity impulse, as measured by the 42 Macro Global Liquidity Proxy, has inflected back to positive after 7 consecutive months in negative territory. The trailing 3-month impulse of plus 147 billion does not even begin to compare to the peak trailing 3-month impulses of roughly 9 trillion recorded in January 2023 and May of 2020. As such, investors would be remiss to expect a repeat of the overwhelmingly positive responses in asset markets as observed from the lows of spring 2020 and fall 2022. Number two, our macro weather model is currently generating a bullish 3-month outlook for stocks, bonds, and Bitcoin, and a neutral 3-month outlook for the US dollar and commodities. The composite signals for stocks, bonds, and commodities and Bitcoin improved due to a phase transition in the 42 macro global liquidity proxy component signal, which again is now trending higher. These signals will cause the target allocations for SPY, AG, and Bitcoin in our 60-30-10 systematic KISS portfolio construction process to increase. And finally, number three, deflation is officially the top-down market regime after dying with inflation yesterday. Talked about that briefly. Deflation is a risk-off regime in which investors are generally rewarded for reducing risk. That includes selling RIPs and risk assets and underweighting cyclical sectors and factors until the top-down market regime transitions to Goldilocks or reflation, the two risk-on regimes in our grid process. That said, deflation is generally much better for asset markets than the previous top-down market regime, inflation. As such, investors should now expect positive relative and absolute performance from defensive assets and defensive sectors and factors. And there's other macro factors, not included in that also tend to do well in deflation. So obviously, source our discretionary investment ideas summary for the updates on what you should be doing in response to that top-down market regime pivot. Transitioning here to my 42 macro dashboard here, we'll give you a rundown of global macro. So right now we have the dollar is getting close to the lower end of its trading range there. Dollar has been one of those factors that's contributed to the positive inflection in global liquidity. So you could see some back off in the dollar in the coming days and weeks. But certainly if you look at the long bow signals here, it's got a bear short-term, medium-term price momentum. So you should not expect any bounce to be sustained unless there's a positive fundamental catalyst for that. Right now, we're also getting a wicked overbought signal in gold here. Or it's actually came down a bit now, but certainly we're getting a overbought signal, still nearly overbought as well in gold. That's got bullish short-term and medium-term price momentum. 10-year treasury yield getting towards the lower end of its range, but not quite. You got 4.32, 4.33 in the low end of the treasury range. So, this is very clear now in a bearish short-term trend. The medium-term trend is still bullish, but certainly if we continue to probe the lower boundary of those ranges in the coming days, we'll start to see at the bare minimum neutral medium-term trend and potentially a bearish medium-term trend, which obviously bullish for bond prices. Let's keep it moving here. VIX is getting towards the near lower boundary of the range, but not quite. And that's probably it here in terms of the current global macro setup. So we'll wrap up with a question from our 42 macro aware community, which I'm extremely proud of. I tweeted last night. I came back from my honeymoon yesterday. And there was quite a few questions in the community, from our clients and subscribers, and much to my one of the coolest feelings I felt in my entire career is when I went to reply to the questions, I saw 42 macro clients replying to other 42 macro clients for the questions. So that's one of the things I'm very proud of in terms of what our team has built, not just in terms of this dashboard, but in terms of this community we built. We have retail investors, we have, novice retail investors all the way up to some of the most sophisticated, well-known money managers across the world that many of you see on TV all the time as clients. And so it's really cool to see them all interact in this safe space for education and for learning, and ultimately for trying to figure out what the hell we all need to do in our portfolios to either retire safely or keep the buy side seat that we're sitting in. And so we're grateful to be a part of that process for thousands of investors around the world. So addressing a question here. We got a question about the downward trend in the U.S. dollar. It says the U.S. dollar slash DXY has declined a lot recently. Is this decline of U.S. dollar sustainable in the next few months? And in our opinion, certainly it's increasingly looking like it's sustainable. And here's why: we have a U.S. economy, that certainly if you look at Q3 GDP, that's growing about 6-7% on a nominal basis. Despite growing 6-7% on a nominal basis, we have a Federal Reserve that's hiked the policy rate to 5.5%. Now, whether you're looking at a basic Taylor rule estimate of where the policy rate should be, which is about 200 basis points higher from here, or just back of the envelope math of saying, hey, nominal GDP, or rather the growth rate of gross domestic income is still, tracking well north of the Fed funds rate, it can be assumed to believe investors can now take the position that, hey, this is a Federal Reserve that in reality is kind of quite dovish. They're very much not achieving their inflation objectives. They're putting out these, in my opinion, ridiculous forecasts for inflation slowly meandering back to 2% by 2026, whatever the hell that means. And so ultimately, if asset markets decide that, hey, this is a Federal Reserve that's not actually serious about creating the pain in the economy that Jay Powell said the economy would require in August of 2022 in terms of getting inflation back to target sustainably, then the market's going to say, well, Fed, you're not dovish enough, and we need to sell the dollar as a result of that. Don't forget the dollar is extremely, I wouldn't say overvalued, but extremely richly valued on a real basis, on a real effective exchange rate basis. And so, the path of least resistance is lower in the U.S. dollar to the extent the market starts to get concerned about the Fed's unwillingness to really push the U.S. economy into a deeper structural downturn. And obviously, the flip side is that you have U.S. and global growth, sustaining itself at a level that is quite positive, which has historically been negative for the U.S. dollars anyway, just given some of these global monetary plumbing dynamics that we're, I think we're one of the world's experts in. We wrote about that pretty deeply in today's leadoff morning notes. So we'll wrap it up there. Darius Dale presenting our macro minute for Tuesday, November 21st, 2023. Appreciate y'all. We'll catch you back here tomorrow. Cheers.